Can $1,000 a month really buy you freedom in just 10 years? Yes or no, depending on whether you plan for inflation, taxes, and rising costs. Most people think the math is simple. Put money in, let it grow. But that's only the surface. The real opponent is time eating away at purchasing power. What looks like $155,000 after a decade might actually spend like $115,000 today. That's after adjusting a 3% annual inflation rate. That difference is where most retirement goals quietly fall apart. I'll show you the exact numbers and 3 practical changes you can make today. And it all starts with understanding how inflation reshapes the value of your savings. Did you know that seeing 6 figures on your investment statement doesn't always mean you're as far ahead as you think? Imagine this. In 10 years, your disciplined saving and market growth add up to $155,000. Sounds great, right? But if inflation averages about 3% per year, that $155,000 would only buy what $115,000 buys today. That's the hidden cost of what many call the silent killer. Your money grows, but your spending power shrinks. In finance terms, that's the gap between nominal dollars, which are just the numbers on your account balance, and real dollars, which are what those numbers can actually buy. This is where most people slip up. They focus solely on hitting a target balance, like a tidy round number, without asking if that future balance will stretch as far as they expect. If you ignore the reality of inflation, you could walk into retirement thinking you've built a safety net, only to find that net has holes. And the scary part is how simple the math is. When prices climb about 3% each year, a dollar today slowly erodes in value until, over 10 years, it buys about 25% less. That's how $155,000 of nominal value shrinks to $115,000 of real value. Looking at the bigger picture puts this into perspective. Historically, U.S. inflation over the past 20 years has averaged roughly 2.5 to 3%. But in recent years, we've seen spikes nearer to 4 or even 5%. Even short bursts at those higher levels can eat away thousands of dollars of future buying power. It only takes a few consecutive years of stronger inflation to shift the line of how much you'll need to feel financially secure. Let's make it more concrete with an example. Say your rent today is $1,000 per month. If landlords increase rent by just 3% every year, that same apartment will cost around $1,349 in 10 years. The place doesn't get bigger or better, yet your budget stretches thinner. Apply that same pattern to groceries, healthcare, transportation, and utilities, and you can see how quickly today's income won't cover tomorrow's expenses. Financial planners often stress this very detail because ignoring it derails even the smartest-looking plans. Too many people track only headline returns, the surface growth of their accounts. Professionals, on the other hand, always emphasize real returns, returns after inflation, taxes, and fees. Why? Because that's the number that decides the lifestyle you can actually afford. It's not enough to ask, how much will I have? The sharper question is, what will that money still buy me when I need it most? If all of this feels discouraging, you're not alone. Saving diligently, yet watching inflation chip away at the future value is a quiet frustration nearly everyone wrestles with. It's like cheering at a scoreboard that says you're winning while knowing the cost of the game keeps rising. And that disconnect, believing you're progressing while falling behind in real terms, is exactly why inflation is such a powerful threat. So what's the way forward? The key insight here is simple. Ignoring inflation makes your plan look stronger on paper than it will feel in practice. That's why the smartest move isn't only about what you invest in, but how you choose to save along the way. In the next step, we'll look at one adjustment that shifts the balance back in your favor, an approach that doesn't require cutting your lifestyle, but changes the trajectory of your contributions year after year. Here's a question most people overlook. Why should your savings contribution stay fixed when the cost of living doesn't? That's where the adjustment trick, often called contribution creep, comes in. Flat contributions lose buying power every year, but by raising your monthly amount roughly in line with inflation, you keep your effort just as strong in real terms. It's a simple shift, but over time it can completely change your results. The math is straightforward. Suppose you start saving $1,000 per month. In year 2, you increase that to $1,030. By year 3, it's about $1,061. Fast forward to year 10, and you're contributing around $1,304 every month. Each step looks small on its own, just an extra $30 or so from one year to the next, but those small increments add up to big differences when carried across a decade. Now compare the outcomes. Flat contributions might get you about $155,000 nominal. Escalating contributions can push that toward $180,000 to $200,000. Same discipline, different math. That shift comes from keeping your savings aligned with reality instead of letting inflation quietly erode the weight of every dollar you invest. What often surprises people is how manageable this adjustment really is. Wages tend to rise gradually over time, usually matching or exceeding inflation. If your income keeps inching upward while your contributions stay flat, you're actually saving a smaller slice of your earnings year by year. Adding a 3% bump isn't upping the pressure, it's simply keeping your commitment consistent as your paycheck grows. And if that still feels like extra strain, think about it in daily terms. Covering a 3% increase works out to around $30 per month on a $1,000 base. That's about the same as skipping one $5 coffee a week. Most people wouldn't even notice the absence, yet that tiny swap funds the adjustment that keeps your plan on track. Better yet, you don't have to remember to make the bump manually. Many payroll systems and investment platforms let you automate an annual percentage increase. Setting that once means your contribution naturally scales up without you thinking about it again. What makes this powerful is how it interacts with compounding. You're not only letting your returns reinvest and build on themselves, but you're also feeding them with larger amounts each year. It's like giving compounding a stronger engine. Instead of growth on a flat foundation, you're stacking higher contributions underneath, which accelerates the outcome. That's why the difference between $155,000 and nearly $200,000 isn't fancy investing, it's discipline paired with design. Once you recognize this adjustment, inflation no longer feels like a force you can't beat. Each small contribution increase offsets rising costs step for step. Instead of falling behind while prices creep up, you're maintaining the real impact of your efforts. It's not about squeezing your lifestyle. It's about structuring your plan so it stands firm as the years move forward. Of course, keeping pace with inflation through escalating contributions is only the first layer of defense. There's another force that can slow growth even when you're diligent, and that's the tax drag on your investment. Next, we'll look at how to protect those gains from tax erosion so more of your money keeps working for you. Picture this. You've been diligent for 10 years, setting aside $1,000 each month and letting it grow. At the end of the decade, your balance shows around $200,000. On the surface, that feels like a huge win. But the catch is that not all of that may truly belong to you. In a regular taxable account, every dividend, every capital gain, even the simple reinvestment of growth can trigger taxes. That steady leakage is what slows you down without you noticing. This effect is known as tax drag, the annual reduction in compounding caused by taxes on dividends and gains. Even if your portfolio earns a 7% nominal return, after taxes, it may behave more like 5% or 6% in a taxable account. That small percentage point difference doesn't sound like much, but over the span of years, it can translate into tens of thousands of dollars lost. Now here's where strategy makes all the difference. Choosing smarter account types. Tax advantage accounts like Roth IRAs and Roth 401ks are designed to eliminate tax drag. You contribute after-tax dollars, but from that point forward, all growth compounds tax-free, and qualified withdrawals in retirement are also tax-free. By comparison, traditional 401ks and IRAs work differently. You contribute pre-tax, but your withdrawals are fully taxed later on. Both have advantages depending on your situation, but the Roth structure is particularly powerful if you expect your future tax rate to be higher than it is today. To see the impact clearly, imagine two investors, each saving the same $1,000 per month for 10 years. One uses a regular taxable brokerage account, while the other funnels contributions into a Roth IRA. With identical investments, estimates suggest that Roth account can grow to tens of thousands of dollars more over that span, simply because the compounding wasn't reduced by annual taxes. That's money you didn't have to earn through riskier bets or higher returns. It's money preserved through structure. The practical takeaway here is simple. If you're eligible, max the Roth-style accounts first. A Roth IRA can take $7,000 per year in contributions in 2024, $8,000 if you're over 50, while Roth 401ks allow much more, up to $23,000 or $30,500 if you're 50 or older. If you can't access these accounts or you've already filled them, the next step is to prioritize tax-efficient investments in your taxable account, such as index funds with lower turnover. That way, you minimize the drag even when you can't avoid it entirely. And don't overlook how little extra effort this requires. You're not asked to find clever loopholes or to chase investments most people don't understand. You're simply choosing a container where your savings live. That container determines whether compounding works at full strength or loses speed year after year. Even top investors emphasize minimizing unnecessary tax erosion because growth rates are fragile. Protecting them is a far easier win than trying to beat the market itself.